Alyssa, we're live. You're muted.
Thanks, Kim. Hi, everyone. Welcome to today's webcast. Today, we're going to be talking about commercial property assessed clean energy, CPACE landscape. My name is Alyssa Roth. I am the Senior Director of Policy and Programs at Greenworks Lending. We're a national CPACE lender, and I'm going to be the moderator for today's session. Before we jump in, there are a few housekeeping items that ACEEE has asked me to read, and then we'll quickly move through this into the presentation and the speakers, and then some time for Q&A. Okay, so as a reminder, your screen is customizable using the various widgets found at the bottom. The presentations can be downloaded as PDFs from the resource list in the menu. Attendees are in listen-only mode, but you can submit questions through the Q&A box at any time during the webcast, and then we'll answer all the questions following the presentations and then at the end. All webcasts are available for on-demand viewing in just a few days. So after the presentations, we're going to have a Zoom discussion room. That's going to be open to continue the conversation, to have additional questions. And you can get there by clicking on the Zoom widget at the bottom of the menu, or you can download the daily Zoom link PDF available on the Engagement Hub. Okay, please be sure to complete the evaluation form after your last webcast and receive a $25 credit towards next year's Finance Forum event. Your feedback helps ACEEE in planning for future finance forums. And lastly, thanks to all the sponsors and partners for their support in the Finance Forum. All right, so let's get started. My name is Alyssa. As I mentioned, I am the Senior Director of Policy and Programs at Greenworks Lending. Greenworks Lending is a leading provider of commercial PACE finance nationally. We were founded in 2015, and we have set the industry standard for CPACE project development nationally. In 2017, we issued the industry's very first securitization, establishing the asset class with a AA rating from Morningstar, and that was a portfolio solely of CPACE assets. In 2018, we issued our second rated securitization, and to date, we financed over 450 CPACE projects in 20 states. We were recently acquired by Nuveen, the asset management firm for TIAA, which we consider a really great milestone marker, both for our company and for the industry as a whole. So if you have any questions whatsoever about CPACE financing, you can always reach out to me, and I would be happy to talk you through the 20 different states that we lend in and any questions you have. So let's jump into our presenters. We have a really excellent panel today. We've got three speakers: Travis Levy from Hannon Armstrong, Kimberly Johnson from Slipstream, and Peter Irwin from NYSEG, or the New York City Energy Efficiency Corporation. So we will get started with our first speaker, Travis. I'll read a quick bio for him, and then we'll move to his slides. Travis is a director focused on real estate transactions at Hannon Armstrong, a leading investor in climate solutions. Travis has over 20 years of experience in banking and finance. He has held credit and sales roles at PNC Bank and Citibank in corporate banking, commercial real estate, and specialty finance. Over to you, Travis.
Okay, fantastic. Well, thank you, Alyssa. Very excited to be here today giving this presentation. This is my first webinar, and given that we're going to be talking about resiliency, I've got my fingers crossed that my internet connection holds throughout the course of my presentation and remains resilient. So we'll go ahead and jump right in. Just a very quick and brief background on Hannon Armstrong. We are the first U.S. public company solely dedicated to investments in climate change solutions. We have approximately $7 billion of assets under management. And we invest in really three primary markets and asset classes, behind the meter, of which CPACE is a component, grid-connected and sustainable infrastructure, which is somewhat of a catch-all, but largely now includes stormwater remediation and ecological restoration. So just some quick illustrative investments here, which will be apropos to the discussion. In 2018, Hannon invested $10 million into CPACE, a CPACE bond, to finance the construction of a Hyatt Centric Hotel in Sacramento, California. And this financed seismic improvements for the property, and again was structured as a PACE deal. We subsequently did a follow-on for $3 million last year, and I believe this project is going to hit CO here probably in the next 30 days or so. So very excited about this one. Another behind the grid project was an energy savings performance contract with the federal government to finance PV solar, battery storage, and CHP at the Parris Island Marine Corps Recruit Depot. Now, this was structured as an ESPC, but I'm going to connect this back to PACE later on in the presentation in terms of opportunities that we're beginning to see with CPACE to address markets that historically had been investment grade ESPC, ESA markets that are now opening to PACE, which is really exciting. Hannon also finances a lot of land under grid connected and, as I mentioned earlier, with sustainable infrastructure, getting more into mitigation credits and financing wetland and stream restorations. But we'll jump right into PACE. So just a couple of caveats here. Hannon Armstrong is a buyer of CPACE. We're not an originator. We originate primarily with a company called Counterpoint Sustainable Real Estate. It's been in business, I think, for just over 7 years. But we also buy from a variety of different originators as well. That's just the firm we happen to have a special agreement with as our originating partner. But we look at a variety of different asset classes. And in the presentation that follows, you very well may see assets, or you may have questions about assets that are not included. Don't fret. By no means is this presentation meant to be exhaustive of all the asset classes or different property types. But rather is just a reflection of our bias, our perspective of the projects that we've actually purchased and have some familiarity with. So if you have questions, of course, talk to PACE originators like Alyssa, talk to PACE administrators for your given jurisdiction, and ask them if your project qualifies, and more likely than not, it probably does. So to discuss PACE at a very high level, and again, assuming folks are fairly familiar with the asset class, it's been around for over 10 years. But PACE is a public-private partnership that allows property owners to finance a variety of projects through a voluntary tax assessment that's placed directly on their property by a state economic or local economic development agency or PACE administrator. CPACE can finance up to 100% of energy efficiency, renewable energy, water conservation, resiliency, which we're going to talk about here, and related and soft costs. So it captures quite a bit of project costs that maybe traditional bank financing would hold back or margin on, where with CPACE, you can pretty much finance everything. Financing is typically collected through your local tax assessor, although there are some jurisdictions that have third-party collectors. But it amortizes over a 10 to 30-year term, not to exceed the useful life of the project, but is fixed rate financing over the entire term, and can go and transfer with the property. So if the property is sold or a sponsor transfers it from one LLC to the other, the PACE doesn't have to be paid off. And it doesn't accelerate like a traditional mortgage does. So it's got some really unique and preferential benefits for financing energy improvements for the long term. So we really like it. Getting into core property types, and again, I'll give another caveat here. just because you don't see the property type here listed doesn't mean that it's not PACE eligible. There's a variety of different property types that can be financed or projects that can be attached to those properties via PACE. So I just talk about these ones here largely because the ones we have most experience with and the ones that really are kind of at the top of the list in terms of frequency. If you look on the PACE Nation website, the frequency of projects thus far tends to sort of group around these particular asset classes. But again, if you've got a hospital or you've got even agricultural projects, those projects are getting done now. So definitely make sure you go through your inquiries and find out if your project qualifies, because there's a variety of different property types that do. But in terms of historically what we have bought, what we have seen, tremendous amount of uptake in hospitality sector with CPACE, also retail in the office environment. Now in the industrial space, the one I'm most excited about, which is finally sort of arriving here, is the large corporate that has a manufacturing facility that's 250 to 400,000 square feet, highly energy intensive, can really benefit from low-cost renewables as well as resiliency, as well as something like CHP, which from a scale perspective fits in a project of that size. And we're talking, 16, 20, 25, $30 million projects, where in the beginning, PACE was sort of more geared towards rooftop solar and smaller projects in the $1 million range. Now we're beginning to see projects that only really work in an ESPC or ESA context now moving into PACE, where PACE becomes a really advantageous solution. So we're really excited about that. Multifamily is another asset class that's increasingly using PACE, particularly during the new construction phase. And I sort of put that off on the side as almost a separate asset class. Not all jurisdictions allow new construction, but new construction and PACE is really a very powerful pairing. Because with CPACE, in new development, you can actually replace mezz financing or preferred equity, financing sources in the capital stack that are way more expensive, sometimes double-digit returns. With CPACE, that can be your 5 or 6% yield. So that's incredibly powerful in lowering the total cost of capital for the developer, maybe even adding a little bit of additional leverage on the project, and giving them more flexibility and a longer repayment term than perhaps they would have with, as finance or, preferred equity that, maybe has a 5 or 7 year horizon. So, again, really exciting things that are happening, and PACE, isn't just confined to retrofits. A lot of new construction projects as well are coming up out of the ground. So to talk now about resiliency, what are we really seeing in the market? What projects have we done? So I would say top of the list here, the one I'm most excited about, as I kind of alluded to earlier, is microgrids. So solar with battery storage and combined heat and power. Again, in the past, a lot of projects, office projects or hotel projects, didn't really have the demand load for a full-on CHP project. They work very, very well, though, with large industrial customers, and we're beginning to see that more and more and more, again, which is very exciting, and we think, probably within the next 6 months or so, you'll begin to see, more and more marquee projects out there in the marketplace that are doing CHP and using PACE. So I think for this group in particular, that's very exciting. Green roofs have been around for a number of years, but I anticipate with Chicago coming online more, New York City just coming online in April, you're going to see a lot of green roofs. Not only, of course, do they help reduce heating and cooling costs, but they're just aesthetically really cool to look at. And I think in a lot of buildings in New York, you're gonna see green roofs. Water conservation, we've had a lot of experience with that in the state of California. Everything from high efficiency sprinklers to AstroTurf to drought resistant plants to my personal favorite, the low flush toilet and urinal. which unfortunately they just don't make very good annual reports. But one day perhaps we'll see some, but perhaps, or at least from the standpoint of efficiency and the standpoint of return on equity, they are incredibly cost effective and are just great all-around projects, particularly in states like California that periodically suffer from droughts. Seismic retrofits, another area where we've seen just tremendous uptake. We've done probably over 50 projects with seismic retrofits, and again, pairs very nicely with new construction in driving down that cost of capital, giving the developer more flexibility, and of course, being able to easily assign the funds against the retrofits, against the improvements themselves. So very easy, cost-effective way to address seismic improvements on new build. Storm roof winds, storm doors, storm roofs, and storm windows. We've seen those in Florida. I believe just in Florida at this point in time is enabled. We've done probably half a dozen projects there in the multifamily space, and some smaller projects as well. Certainly those areas that are prone to large storm events and rising seawater, I think we're going to increasingly see that as a development and a good fit for PACE. And then finally, flood mitigation, which we haven't done one yet. Relatively new jurisdictions coming online that allow it, New Jersey and Rhode Island. But I think more and more, obviously, in coastal cities along the Atlantic and down into the Gulf states, you're going to see more and more CPACE projects that are geared towards flood mitigation. So with that, I will turn it back to Alyssa.
Thanks, Travis. That was great. It's really exciting to see resiliency become more mainstream in the CPACE world. I think that's one of the really exciting trends we're seeing right now. We've got legislation all over the country, new legislation standard to have resiliency in there. And there are several statutes that are being amended to allow these exact types of retrofits and upgrades that you've talked about. So thanks for that great presentation. And it's a great segue to our next speaker, Kimberly Johnston, who works at Slipstream and is an administrator who facilitates these exact types of CPACE projects. So let me read a quick bio for Kim. Okay, with more than 8 years of CPACE experience and 25 years of experience in finance, program, business plan development, marketing, communications, Kimberly leads marketing and outreach efforts for PACE Wisconsin and Slipstream's financial programs. Kim was on the ground floor of the development of the PACE Wisconsin program that currently serves 46 counties in Wisconsin. As part of program launch, she developed program guidelines, education tools, marketing, and mapped out engagement for participating stakeholders, developers, lenders, economic development orgs, and property owners. Today, PACE Wisconsin has facilitated over $72 million in clean energy financing for commercial property owners in Wisconsin. Kimberly was also part of the core implementation team that recently launched Cook County, Illinois CPACE program early in 2021. CPACE provides commercial and industrial building capital for PACE projects that may lower operating costs, generate clean energy, instill resiliency, and promote water use conservation in commercial properties. Prior to Slipstream, Kimberly worked with World Council of Credit Unions, managing the launch of USAID, Rabobank, and Asian Development Bank microcredit and microfinance development programs in Europe, Asia, the Caribbean, and Africa. Welcome, Kim, and hand it over to you.
Sorry, Alyssa, for such a very long intro. My name's Kim Johnston. I work with Slipstream and the PACE program administrator for PACE Wisconsin. Slipstream supports clean energy efficiency and energy financing programs with the goal of helping to create a lower carbon future. Today, I'm here to talk specifically about PACE Wisconsin and what we've seen over the last few years. We really believe that it surrounded itself with partnerships that partnerships have made the difference in our outreach. We've worked with the Wisconsin Counties Association, the League of Municipalities, Von Briesen and Roper, state agencies, and local governments. Today, we have over 47 different member counties that participate in the program and install a uniformed approach. So that means they have the same PACE Wisconsin Board of Directors, uniform guidelines, and transactional documents. We're thinking that makes a huge advantage for the different counties that do participate. We currently have an open market system, which allows for local lenders, regional lenders, and national lenders all alike. I know that we did cover the benefits of CPACE briefly, but really it is the long-term fixed rate financing that provides for more operating capital. The updates basically pay for themselves with almost immediate savings on utility bills. We have a few examples here. We have office, industrial, multifamily, retail, healthcare. We've seen quite a bit of memory care, hospitality. We have over 24 different projects that have went through, not-for-profit, agricultural, and mixed use. Really in Wisconsin, it's easier to tell you what doesn't qualify for PACE financing versus what does. What doesn't qualify in Wisconsin to date is residential PACE and also government-owned buildings. As you can see, we have 51 different closed projects to date, which is close to $80 million in clean energy impacts. As you can tell, that hospitality was really one of the early adopters here. We have, it looks like the number did fall off of there. We have 24 closed hospitality programs or projects, 8 mixed-use case, 6 multifamily, 4 office and industrial, and then 2 in healthcare sector. We also recently closed a ag project with $3 million worth of solar on a dairy farm, which is unique and interesting for us to do outreach to yet another sector. Some of the eligible improvements that we traditionally see typically include water and energy improvements, LED lighting systems, building envelope, HVAC systems, heat pumps, low flow fixtures, and then also heat recovery systems. For renewable energy, we're seeing quite a bit more on solar PV, both on the smaller projects from the 250 and up to the larger projects with the larger solar, for the example, with the agricultural project that just closed with $3 million in solar on a dairy farm. Also eligible for renewable energy measures include battery storage, biofuel, and wind. Brownfields is another measure or eligible improvement. Property owners can also include the site assessment, remediation, lead or asbestos abatement, and the standardization of the site prep before the purchase of the property. Some of the projects, various projects that we've had in the past have included renovation and replacements. We have included some of the smaller projects here, so you can see that it uses both $250,000 or smaller projects up to the $9 million mark for an adaptive reuse or new construction piece. So for example, the Waterloo Technology Center used HVAC and lighting. It's very similar with Univoil, which is a manufacturer that used lighting and HVAC. And with H&H, we used some very small solar on the rooftop there too. For adaptive reuse and new construction, we haven't really seen a downturn with COVID in Wisconsin. Actually, the opposite is true. We've seen an uptick in the number of closed projects with commercial property owners really looking at CPACE as an alternative to the more expensive mezzanine debt. As I mentioned, we have 24 different closed projects under the hospitality area. These not only include hotels, but it also includes areas like ice skating rinks and civic centers. So a lot of different entities have looked into CPACE and how to move over that more expensive mezzanine debt. One of our case studies here is for the Hotel Indigo. It is a historic former Mott's paint plant facility, which was 102 years old. It was a historic center And what they did was swap out roof insulation, wall insulation, efficient windows, along with an HVAC system that today will save them on annual approximately $90,000 a year, for an overall savings of approximately $2.4 million over the lifetime of the project. But more importantly, it has taken what was a very depressed part of the city and building specifically and turned it into something that has created jobs and added value to the surrounding environment. Typical PACE financing terms in PACE, Wisconsin can range from 5 to 30 years. The average loan size typically is approximately from $250 to upwards of $10 million. You can go up to $50 million in the PACE Wisconsin program. Some of the requirements is that you must have mortgage lender consent. There is a savings guarantee for projects over $250,000. There does need to be an energy assessment that is done. The security does ride along with the property tax, and the term of the loan is equal to the usable life of the measure. There is a calculation that's figured out, and the documentation is on the PACE Wisconsin website for more information on that. The loan to cost can be up to 100%. And we've really figured that we have gotten where we are due to the partnerships that we've built and the different people who've helped us get here. Again, the work with the Counties Association, the League of Municipalities, the local governments have really helped bridge from county to county up to 47 right now, and we hope to advance through the rest of Wisconsin within the next few years. If you have any questions, please do check the PACE Wisconsin website at pacewi.org.
Thanks, Kim. That was great. Just a reminder to everyone, if you've got any questions at all, you can submit them in the Q&A box, and we'll go over everything at the end. Okay, so now we have our last speaker of the day. This is Peter Irwin, who's coming up. He's the Associate Director for Programs at NYSEG. Peter helps manage NYSEG's PACE platform and supports NYSEG's work with the New York City Accelerator, Green Pre-Development Lending, and Business Development. Prior to joining NYSEG, Peter was a project manager at the New York City Department of Housing Preservation and Development, HPD, where he executed the financing of numerous rehab projects for affordable multifamily and supporting housing. Peter holds an MS in urban planning from Columbia and a BA in mathematics from Hamilton College. Over to you, Peter.
Thanks a lot, Alyssa, and sorry for the delay. So for my presentation, I think we've gotten a really good overview of CPACE, and so a lot of my slides will focus on the legislative environment in New York City specifically, but I know there are some folks on the call that represent municipal governments, public agencies, utilities that are working with New York City and other places. So I really hope this will be relevant, and also really excited that New York City's CPACE program is finally coming online, as Travis mentioned, this summer. If anyone thinks that New York City is the center of innovation, let me dispel you of that illusion now, since it's been about 10 years working on this, but we're really excited to bring it to the market. Just quickly, NYSEG is it's the New York City Energy Efficiency Corporation. If we sound like a public agency, it's because we were founded by the City of New York in 2010 using Recovery Act seed money from the recovery at that time. Since then, we've done about 100 projects, mostly in the affordable multifamily sector. We've, those projects are worth over $200 million of investment. We've done a lot of efficiency work around, lighting, HVAC, building controls. We've done a lot of fuel conversions, CHP work, distributed generation. We now focus on solar and also battery storage. So really all technologies and with a variety of different products. And that's kind of on the lending side. NYSEG is also a policy shop, so we consult with other municipalities about some of the work that we do and what it means to be a local green bank. And we're also a very close partner with the city and specifically with the Mayor's Office of Sustainability in bringing the CPACE program live. So wanted to start with an overview of climate legislation. I think during NYSEG's lifetime, since about 2010, the city has also been really busy. The first two local laws at the top are benchmarking and energy audits, local laws 84 and 87. These were really important because, as we'll see in a second, the city now has 10 years of actual energy use data upon which to develop other ensuing laws. But just for context, large buildings in New York City are required to obtain a 10-year energy audit and also annually submit utility use data through Energy Star Portfolio Manager. So that's the concept of annual benchmarking and 10-year audits. In April of 2019, the city passed the Climate Mobilization Act, encompassing several laws. So those are outlined here. There's a requirement that a certain percentage of rooftop space is dedicated either to green roofs or solar. Buildings in New York City, you may have seen this, are beginning to get energy efficiency grades based on kind of the percentile they fall into among their use groups. So just like you could walk into a restaurant and feel comfort that it has an A from the health department, you might see that same building has a B or a C for its energy efficiency rating. Local Law 96 is the PACE law. So with that established a PACE program, and we've been sort of putting that into place over the last year. And Local Law 97, which I wanted to focus on the following slide, is a law that basically limits the amount of greenhouse gas emissions that can be associated with large buildings in New York City. And that, as we'll talk about, is a real driver of demand for investment in clean energy in New York City, and really is the stick, and PACE, as we'll see, is the carrot. So more on the Climate Mobilization Act. This essentially is a really big investment. I'll call it an opportunity. Building owners know this as a requirement that's coming into effect in 2024. The law covers buildings that are larger than 25,000 square feet, and that accounts for almost 50,000 buildings in New York City. So it's a huge impact. I will note at the beginning of this slide that there are a few carve-outs or exceptions to the law. The most notable one is that if a building is multifamily and contains more than 35% of its units as affordable regulated units, then that building is sort of exempt from the most stringent requirements under the law. But every other commercial building in New York, a large commercial building in New York City, is covered. They will be assigned, they will have to now report their energy use converted into greenhouse gas emissions using fuel coefficients that are defined in the law. And they will get basically an emissions limit based on the square footage of various use types in their building, and will be penalized for not complying with that limit starting in 2024. I think, for context, maybe the worst 25% of buildings in New York City that are covered by the law will have to invest in order to comply with the limit starting in 2024. And then the 75th percentile, or the 75% of the worst performers in New York City, will have to do something to comply by 2030. So you can see that there's a really big impact. The statistics I have up here are from the Urban Green Council, projecting that the amount of investment that's going to be required in buildings to meet the standard over the next, up until 2035 is upwards of $20 billion. And in the slide here, broken out between multifamily residential and other commercial. think it was important to highlight multifamily here. Travis and Kimberly spoke to the types of buildings that are eligible for PACE financing. There are particular challenges, I think, to using PACE to invest in the multifamily sector, and those challenges are important to address in New York City's program because there's a huge investment opportunity and a huge onus on those buildings to invest to comply with the law in New York City. And so, where does CPACE fit into this environment? We've established a program under the sort of ecosystem of the New York City Accelerator. The New York City Accelerator provides free technical assistance to building owners, help them understand the laws, what they need to do to comply, design projects, link them to energy audit firms, energy efficiency contractors, financing providers. And as an arm of the Accelerator, we now administer a PACE financing program. So like was mentioned, it's an open market program. There's an RFQ for lending organizations that are interested in originating CPACE in New York City. That's available on the Accelerator website. So we're accepting responses to the RFQ. We'll hope to pre-qualify lenders, and they will be able to originate CPACE with competitive rates and terms. In terms of eligibility, it's currently a retrofit program for energy efficiency and renewable energy measures. We do expect that new construction projects will be eligible to receive CPACE later this year. So that's a result of an amendment to the local law, which was really positive. How we talked a little bit on this panel about resiliency and water conservation, other types of measures. How we look at energy efficiency and renewable energy is based on a cost effectiveness test or a savings to investment ratio. So if the project includes measures that over the lifetime of the loan are saving the building energy, you can add other types of measures into the project so long as on a holistic basis, the project demonstrates a savings to investment ratio of 1.0 or greater. So primarily energy efficiency and renewables. In certain cases, related measures can also be financed by PACE. A lot of the other terms, New York City has not set out to dictate a lot of the CPACE financing terms. We want to be responsive to the market. I think that some of the conditions that Kimberly spoke to around 100% financing, mortgage lender consent, our program is pretty analogous. So I would encourage you to reference the program guidelines that are now available. I spoke to the cost effectiveness requirement, and finally measurement and verification. So it's really important to the city not only to open up this avenue for financing, but to quantify, measure, track the public benefit that the city is getting by using its taxation authority to implement this program. Fortunately, there's already the benchmarking and energy audit laws that I spoke to. So we as the administrator will just ensure that buildings are submitting benchmarking, and we'll use that utility data to measure the impact of PACE on the buildings that are benefited by it. I would point out, which is true all over New York State, there's an energy audit requirement for projects that are incorporating energy efficiency measures. And analogously, there's a feasibility report requirement for projects that are implementing renewable energy measures. The energy audit is the same type of energy audit that large buildings already have to obtain every 10 years under Local Law 87. So we've tried to, as much as possible, piggyback on the legislative infrastructure that exists in kind of creating the requirements for the New York City program. So I guess a couple of closing notes. We saw on the earlier slide that multifamily buildings make up a huge percentage of the buildings that are covered by the law. And to us, that means that that issues around multifamily buildings receiving PACE need to be addressed. And chief among those, I think, is mortgage lender consent. We're working with large banks in New York City some of the largest mortgage holders. We're working with the New York City Bankers Association, really around education and encouraging them to see PACE as additive. We know that it increases buildings NOI in many cases. There's a cost effectiveness requirement to the measures that are being installed. It increases building values. So really, at the end of the day, could increase the senior mortgage holder's position. We think so. There's education going on around that. We've spoken to public agencies about using PACE, not just consenting to PACE on buildings within their portfolios, but actually originating PACE and using it as a tool to finance affordable housing or finance improvements to buildings in their asset management portfolios. And that's been a really productive conversation. So we're hopeful that affordable building owners and multifamily building owners that are covered by the law can take advantage of PACE, just like other types of hospitality and multi-tenanted office buildings will do. Like I mentioned, so there's an RFQ available for lenders that are interested. There are program guidelines available on the website. Additional documentation, legal documentation is coming soon. So I encourage everybody to check out the NYC Accelerator and click the PACE financing website for as much information as is available. I think I'll stop there.
Thanks, Peter. Can you give us any hints or clues about when the program might be ready for closing projects?
I think that there's a motor outside my window at the perfect moment, but I think that we're encouraging lenders to seek to pre-qualify as soon as possible. We've seen a ton of demand already. We know that lenders have projects in their pipelines, and if that's the case, we'll do everything we can to expedite our reviews. So whether there's an official launch party or not, I think we'll start to see projects apply, in really a matter of, I'll say weeks. Hopefully this is not recorded, but I think it's really close.
Okay, I think that's a fair and diplomatic answer. All right, well, thanks everybody. We've got 15 minutes left to do questions, and we've got some great questions coming in. So at this time, I'll ask all of the presenters to turn their microphones and their cameras back on, and we can go through some of these questions that have been coming in. All right. So let's start out with a question from David Hodgins, and I will direct this to Travis first, but then anyone, Peter or Kim, if you want to jump in, please feel free. How do you manage the inclusion of a scope that does not produce a direct financial savings benefit, such as resiliency projects?
So it's really somewhat of the art versus the science of PACE, because a lot of those resiliency components actually have components with larger energy efficiency improvements to a property, and there are some types of resiliency improvements, like seismic's a perfect example, where there's no energy savings really directly. But you can quantify some savings in terms of, what happens if the building didn't have this improvement, which often, I should say often, is required in the state of California, to have these seismic improvements on existing buildings. And what happens? What's the value of potential lost life, or having to rebuild a building completely? So seismic, is a perfect example of resiliency that's PACE qualified, where it's difficult to quantify directly, through an energy audit, but it has, certainly has other benefits in terms of value to the property and value to human life, and value in terms of additional inputs avoided by not having a building you have to completely knock down. But I would say, it really depends, program to program, jurisdiction to jurisdiction in terms of, what you can kind of squeeze in, what can be a soft cost, what can be a component cost of an energy efficiency upgrade. And you'll find oftentimes, the PACE originators are very skilled and very creative in terms of how they approach a project. So, if you want to redo your lobby, that's probably going to be difficult to qualify for PACE. But if you're putting in, say on-demand elevators and you need to replace the cladding or some elements, of the exterior of the elevator, that probably is going to qualify. So, it all comes down, I think, to, the individual jurisdiction, what you're trying to do, and then also, the PACE originator's experience in being flexible and creatively trying to solve the problem.
Yep, that's great. And I'll just add on to that there's usually, with resiliency measures, a financial benefit associated with insurance premiums on those types of projects that can be included in savings to investment ratio calculations. And some programs actually have resiliency measures exempt from that SIR calculation. And there are other criteria for meeting those. And that's exactly what Travis was just describing, how it's jurisdiction to jurisdiction, program to program. Thanks, Travis. Okay, we have got a whole bunch of questions specific to NYSEG. So I'm going to ask a few of them now and then remind everyone that you can join us on Zoom afterwards to dig even deeper with Peter on some of the specifics in New York City. Okay, so Peter, I hope you're ready. Can you describe how utility programs interact with CPACE in New York City and the opportunities and challenges related to Con Ed's involvement?
It's a good question. And I might not be expert here, but utility incentives can work with PACE loans just like they work with other types of financing. So if there are incentives available that pay for a portion of the project, they can certainly do so here. One thing that's going to be different about a PACE loan is how it's billed for. And in New York City, lenders will not bill, so building owners will not be charged during construction. There may be various construction terms accounting for how interest, is accounted for. Payments will begin once construction is complete, and PACE charges will be paid on the January 1 and July 1 tax bills. But and fixed rate, like was mentioned. But in terms of the amounts covered, they could be offset by utility incentives. If those incentives come in post construction or post M&B periods, the payment structures can adapt to basically account for those types of payments.
Great, thank you. Can you talk about the different programs? So you've talked about a whole bunch of different climate laws and legislation in New York City and different energy audit requirements. Does each local law have its own energy audit requirement, or will the same energy audit cover a building to comply with all local legislation?
Right. So I think it was Local Law 87 requires large buildings, 25,000 square feet and greater, to get an energy audit every 10 years. That same energy audit can be used to support the measures that are eligible for PACE financing, provided that the audit is 3 years current or was completed within 3 years of the project. So, there might be some projects that need to reach back out to the provider and refresh it. They may want to look at new measures since the audit was provided, so there may be updates that are required, but there's nothing specific to the legislation or the program guidelines that would require a building to go and get a new provider and a new audit. And it's supposed to be a setup to minimize the expense and time, basically, and kind of piggyback on the requirements that are already out there. One other thing I actually meant to mention during the presentation, speaking about affordable housing, the agencies have created their own standard around what building owners should do to explore energy efficiency measures. So typically, affordable buildings will get an IPNA, Integrated Physical Needs Assessment. And on a case-by-case basis, NYSEG as the administrator will look at that and see if it can kind of qualify as a qualified energy audit for purposes of PACE financing, so that buildings that are in HPD's portfolio or HDC's, the housing agency's portfolios in New York City can qualify for PACE financing without taking on a lot of extra cost.
Great. Thank you. That's super helpful. Okay, I've got one more for you, and then I'll give you a break. So can you talk about the funding sources for CPACE loans in the NYSEG program? So will NYSEG itself be providing financing for projects, or will it only be third-party lenders? And can you talk all about the terms and the rates?
Yeah, so I am speaking to everyone today solely as a NYSEG, the PACE administrator company, and the program is an open market, so any lender can seek to pre-qualify and then originate loans using, based on their own cost of capital. NYSEG, the business development transaction management team, may qualify as an approved lender, and they are going to be subject to all the same lender requirements that the city has established, and that NYSEG, the administrator, will be checking for. NYSEG has its cost of capital. Like I mentioned, we were seeded by the federal government a long time ago. We also have other sources, other capital providers who will have their sources of capital. So the program does not prescribe interest rates or terms. And hopefully that competition will be beneficial to building owners.
Very good. Thank you. Okay, you're out of the hot seat. We're getting a few questions about the trend we're seeing recently with new construction really on the rise. So Kim, I'll ask you first, and then of course, Travis or Peter, feel free to jump in. But can you talk about the way Wisconsin is processing applications for new construction, if you're seeing an uptick there, and any thoughts you have on what the future of new construction looks like within CPACE? Kim, you may be on mute. Okay, unfortunately, we can't hear Kim right now, but Travis, I'd love to hear your thoughts on new construction.
Sure. Alyssa, can you hear me now?
Yes.
Okay, perfect. So yeah, new construction has been a real growing part of CPACE projects and CPACE opportunities probably over the last 3 or 4 years, particularly a lot in the hotel space, mentioned earlier in the multifamily space. And I would say in terms of opportunities that we were seeing pre-COVID, probably 80% new construction, 20% retrofit. That's probably a little bit more like 50-50 right now. And I'm hopeful. I like new construction. I totally get the value add from the developer's standpoint, but in terms of impact, a measurable impact, the savings to investment ratios are just way, way higher on retrofit projects. So hopeful we're going to see more of those this year. And again, as I mentioned, as the large corporates begin to look at this, particularly, and I say large corporate, I mean middle markets as well, firms that are not historically investment grade or rated entities, where, the energy savings performance contract is kind of, fits really well when everyone's investment grade rated. It doesn't work so well when you have unrated, counterparties, but PACE really is the structure or the credit product that solves that. So as it gets more and more uptake, and I think as lenders begin to be more knowledgeable and accepting of PACE, and the asset class is just more mature, I think we're gonna see, you know, possibly a tilt maybe back towards more retrofits.
Mm-hmm. Yep, I would actually agree with everything you just said. Kim, you want to give it another try with audio?
Yeah, can you hear me now?
Yes, I can.
Perfect. We're seeing probably about a 50-50 split in Wisconsin, and it isn't just segregated to the metro markets versus the rural areas. So we are seeing new construction in the application pipeline. Everything from mixed use, multifamily. We're working with Dane County specifically in Wisconsin on affordable housing as a pilot. So these are all part of a new construction effort. So it's actually a really exciting thing for the Wisconsin economy.
Great. Peter, anything to add?
You know, I think Travis made a good point. Codes are getting stricter, especially in New York State and New York City. My understanding is that the city, you know, will expect buildings to still show savings above what a code solution would look like in the new construction setting. So in some ways that does make it more difficult. But I do think PACE, you know, can accommodate longer term. So to the extent that those savings, or, you know, new construction obviously have longer useful lives, and the savings pay out over that term, it's something that new construction can work well with.
Very good. Any idea when new construction may be ready to go in New York City?
A couple, you know, legislative steps that go into it. So the amendment was passed, I think, in March to the local law, which it's the same exact amendment that was implemented to the state law. And then New York City has what's known as the rulemaking process. So Department of Finance is designated as the agency sort of implementing PACE, for lack of a better word. So they then